Today we're seeing a pretty rare red day across the S&P 500, and that weakness still holds true even when we zoom out over the past 5 sessions. But if you're looking for some bullish news, we've got it for you. Historically, November has been the best month for the market, dating all the way back to 1950. But still, in this video, I want to focus on something that's unusual right now, a handful of growth stocks that have completely crashed, even though over 90% of the S&P 500 has moved sharply higher in the past year, and with investor sentiment shifting from extreme fear to neutral, and in fact job openings collapsing since the rise of AI tools like ChatGPT, there could be an opportunity forming, especially with Warren Buffett, who's sitting on a record $382 billion in cash, almost 27% of Berkshire's assets. So let's break down 8 beaten down growth stocks and figure out whether they're a buy the dip opportunity or value traps. Kicking off with stock number 1, Duolingo, and as always we will run through our own valuation of each company. Now this one's battered 16% year to date, and over the last 6 months battered down 44%. Now it's pretty much trading right there around its 52-week low. Now look, Seeking Alpha and Wall Street do give this company a buy rating, but it is on the weaker side. It isn't even at the 4 out of 5 region. 3.85, 3.84 out of 5. We wouldn't necessarily call these respectable or strong buy ratings. Now look, Duolingo is a strong growth stock, an A+ rating where they grew top line 40% last year, expected around 34% in the upcoming year, well above the sector in comparison at the low single digit. But one thing to point out is that historically Duolingo has been growing at a faster rate. Earnings per share though looks very respectable, projected 41% over the next 3 to 5 years, significantly higher than the sector at 10.2, and they're also an incredibly profitable company as well. We get an A, gross margin 72%, significantly higher than the sector at 39%, pretty much in line with their 5-year average. But bottom line does show strength, 13% net income margin, significantly above the sector at 4%, and interesting to note that their 5-year average is actually a decrease, so strong efficiencies have been noted. They're also generating a fair amount of cash from operations at $336 million, when on the 5-year this was averaging $129, so lots of efficiencies. That is great to see for Duolingo, and probably more importantly is what does the valuation tell us? Now they get an F if you do want to look at a forward P where it sits at 42. You're paying a 146% premium to the sector, although we should let you know that within this sector median there are a lot of poor quality companies. Duolingo, just based on what we saw on growth and profitability, does look top tier, and their own 5-year average, well, 302, highlighting they're trading at an 86% discount. Now, given this is a strong growth company, we would say maybe more applicable to look at the PEG ratio, where we typically, for the price to earnings growth, want to see below 2. This is now looking to sit around the 1 mark. Some people could argue this is becoming too cheap to ignore, and also a lot lower than the sector, meaning you are getting a 39% discount. What are the institutions doing with their 92% ownership? Well, they sold around $3.2 billion worth of shares in the last year. They bought a little bit more, same time frame at $3.7 billion. But interesting to note, in Q3, most recent quarter, they did buy a lot more shares than they did sell. We would flag though, institutions fairly inconsistent. Some quarters they're buying more, others they are in fact buying less. So just to let you know, no real clear indication of whether overall they're bullish on the company. We'll just flag over the more recent quarter and over the last year, they've been buying more than they have in fact been selling. And getting into our intrinsic value for Duolingo today, we get to $355 derived from the DCF model. Now we'll talk about how we arrive there. We have the free cash flow year on year. Moving forwards, we've used a growth rate of 15%. Now you could argue these numbers aren't what you would have, but they are subjective. You can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, Duolingo or any others, where we've used a low of 15, medium 20, high of 25, and probably the most important factor here is to say, as of today, baked into the market value is 10% growth on a reverse DCF. that is over the longer term. We've also used the future free cash flow of 2025 as what analysts are expecting for the full year, and using that low rate, conservative 15%, with a discount rate, we get the present value of future free cash flow terminal price, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, getting to 355. That actually indicates 33% upside. Now, you may have seen those growth statistics and believe we're being way too conservative. Well, look, at the middle rate, 20%, $473, 78% upside. And if you want to go one step further, and for completeness, 25%, 628, indicating more than a double, 136% upside. So let's be conservative, use the low rate today for Duolingo at 15%. We're not done there because we always like to kick things off with a 10% margin of safety. We buy if it meets the 3 criteria: wide moat, strong financial metrics, good forward-looking data. We don't even need to see the acceptable buy price because this is already flagging as of today at 266. You're getting a 25% margin of safety, which is where we would typically start to dollar cost average if we do like the company. Bear in mind, we are also using the lower growth rate of 15% today. Question is, will AI seriously disrupt this company, or will it be a massive benefactor? And are we looking at a company that is now trading at a steal of a price? Wall Street themselves, even with the weaker side of a buy rating, see this at 425 in the next year. That is 60% upside. Some would say that is in fact a screaming buy. And if we were to use the middle rate, which is typically what we start off with on the channel at 20%, well, you are looking for Duolingo today a 44% MOS. So stock number 1, let us know your views. Is it a buy, hold, or in fact complete avoid? And before we jump into stock number 2, we want to let you know we have released our latest free weekly article. We drop one every single Sunday morning to your inbox. Yesterday's copy, we're talking about 3 stocks we're buying in November, but as always, we do cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of November. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a spreadsheet of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock that's crashed is Adobe, down 24% year to date. Over the last year, down 29%. But over the last 10 years, it's still somehow managed to outperform the S&P, up 284%, trading similar to Duolingo around 52-week lows, and very similar again to buy ratings, although we would point to say they're on the weaker side, and their valuation does come in at a C. In fact, if you're looking at it from a forward P, you're getting a 35% discount to the sector, 48% discount to their 5-year average, and very appealing on a PEG basis, 1.1, 36% discount to the sector, 42% discount to what they do typically trade at. And we can see some of their valuation metrics are in fact now sitting at decade lows, with the growth at a D+, although we would say this company is very consistent, grew top line 11% last year, projecting 10% this year. That is above the high single digit of the sector, but actually slower than their historical, which does on average sit around 13 to 14%, whilst projecting respectable 14% EPS growth over the next 3 to 5 years, in line with both comparatives sitting around 15 to 16%, and profitability looking incredibly attractive. Gross margin 89%, well above the sector at 50%, slight improvement to their 5-year, nice to note efficiencies. Bottom line 30%, we see the sector much lower at 4.5% and pretty much in line with their historicals, and they're generating nearly 10 billion of cash in the last year, much better than their 5-year average of 7.4, so we are seeing improvements. And institutions with their 82% ownership selling 22 billion in the last year, bought a bit more at 28 billion, although in the most recent quarter we can see they sold more than they did in fact buy. If you want to see that exact trend, well, we would have to in fact keep going to around Q3 2023, although by only a slight margin. And our intrinsic value at $465 from the DCF is using the lower growth rate at 4%. Look at this. On a reverse DCF, it is projected, if you're buying at 339, negative 1%, that is what is baked in. And at the lower end of 4%, you're looking at 37% upside. At the higher end of 12%, which some would say is in fact reasonable, a more than double at 126. So using the low rate of 4%, you can already see, similar to Duolingo, 27% margin of safety. Wall Street themselves 465 into next year, 37% upside. And similar questions from what we just discussed from Duolingo. Is AI going to be a disruptor for the company or a massive benefactor? And if we do want to look at the middle rate at 8%, well, clear and obvious, the margin of safety will sit higher at 43%. So let us know on Adobe today. And then we move on to Waste Connection. Maybe you want to consider if you are looking at waste management. Year to date, down 3%. Over the last 6 months, down 16%, but over the last 10 years, a massive outperform of the S&P, now trading at its 52-week low. Not only a buy rating from Seeking Alpha, which is incredibly weak, but Wall Street 4.44, very near the 4.5 to flip it into a strong buy. And worth highlighting, the forward P now sits just below 30, historically though around 35, so this is one thing that we would say in consideration of a possible undervaluation signal. And the other one is when we look at the blue tunnel, for newer viewers, this signifies the intrinsic or fair price. It's just sitting outside the bottom end, something we've not noticed in the last year. Hence why we would say again, confirmation of an undervaluation signal. One that if we zoomed out to the last 10 years, you can already tell the market believes this is a high quality company because it very rarely, unless you go to 2023 or the beginning of 2024, does it slip towards the bottom end. We also love the fact the intrinsic price has historically been moving in the upwards trajectory. Now their growth does sit at a C, 7 to 8% year on year, projected similar over the next 12, much higher than the sector at the mid-single digit. Over the last 5 years though, we can see it has grown at a slightly faster rate. Earnings per share projected 10% growth, little bit lower than both comparatives around the 12% mark. And profitability at a B+, 42% gross margin above the sector at 31, small improvement to their 5-year average of 40.7. Bottom line though, little bit of weakness at 7%, not because it's in line with the sector, but actually lower than their 5-year average of 9%. But great to see they are generating more and more cash from operations, 2.4 billion versus historic 1.9. And with institutions holding 86% ownership, selling 4 billion in the last year, they bought twice as much at 8, and they also bought nearly twice as much in Q3. Very bullish in the longer term and in the most recent quarter. If you want to see the reversal, well, you'd have to go Q1 2024. In our intrinsic price for Waste Connections, which as always, you can grab a copy of the model by clicking below, comes to $178. Now you'll notice on the DCF, a little bit higher at 201, we use a growth rate of 8%, baked in is 5.8, may give you a clear indication whether you see this as undervalued or not, and considering all three, you are getting an 8% MOS. Wall Street themselves bullish, near strong buy rating, 210 into 2026, 27% upside. If you wanted this at a 20% MOS, well, a buy at 143, at 25, 134. But let us know, we have recently in-depth covered waste management. Maybe you prefer that one, or you see this one as a better opportunity. Do give us your thoughts. We then move on to Lululemon, the definition of a company that's been absolutely slaughtered just in 2025, down 56%, over the last 6 months, down 40, over the last year, down 47, over the last 10, somehow still managed to outperform the S&P on a downward trend since the back end of 2023, where it was trading over $500, trading again like most today at it or near its 52-week low. Traffic light systems, strong sell from quant, incredibly rare to see. Hold rating from Wall Street, weak buy rating from Seeking Alpha. And we know on the valuation side, at a C is trading at a 22% discount to the sector on the forward P, 64% discount on the 5-year average, and a PG sitting at 1.7, which is pretty much in line with the sector, but actually 20% discount than what they've traded for historically. And we can also see this one is trading on some valuation metrics at historical lows. Now growth sits at a D. They were up around 9 to 10% last year. This is expected to drop to 6 in the coming 12 months. Still above the sector in the low single digit, but just look at the last 5 years, Lululemon was a very, very strong growth company. And we also see the massive drop in the EPS, projected 8%, below the sector at 10 and their own historical 17%, but it is good to see at least they are profitable, looking good at an A, 60% gross margin above the sector at 39, little bit above their 5-year at 57. Bottom line, also noting efficiencies, 16.4%, sector much lower, likewise their 5-year 14.6, and they're generating good amount of cash from operations at 1.9 billion, considering 5-year average does sit at 1.5. And look, institutions with their 85% ownership selling and buying pretty much the same amount of shares, bought twice as much in Q3, but we actually see the reversal in just the previous quarter, so no real conviction from the institutions. In our intrinsic value at $212 from the DCF model does in fact come with a 0% growth rate. Baked in is negative 3%, may already give you an indication of whether this is a potential value play. If you see this at 10%, which is the higher end, that is more than a double. So 0%, in fact, putting in no growth whatsoever, you are getting today a 22% MOS. Wall Street, they see this at 195 into next year, 17% upside, may get you excited, maybe not. And for consistency, at the middle rate of 4% today, you are getting obviously a large MOS at 42%. So let us know where Lululemon stands in your thoughts overall. And then we move on to what was historically a growth company, Old Dominion Freight Line, down 22% year to date. Over the last 6 months, down 12%. Over the last 10 years, like a lot today that have started to crash, still outperform the S&P, up 553%. Trading at its 52-week low, again, thereabouts. Respectable buy from Seeking Alpha, 4 out of 5 you could argue. Wall Street, very weak buy at 3.52. Remember, 3.5, it does flip it from a hold to a buy. And Quant, whilst on a strong sell, are giving it that sell rating. Now this one does trade a forward P of 29, not too dissimilar from their 5-year average. And given the fall off this one has had, you could argue even that is very high for ODFL. And we're also noting a reasonable signal, but we do want to make it known that this one intrinsically is decreasing over the last year, so whilst may look good, just do factor that in, for which over the last 10 years the message is clearer. This one looked like it peaked at the beginning of 2024, since then it is in a downward trend, and their revenue not looking good, down 6% last year, expected flat this upcoming 12 months. Sector, whilst in the mid-single digit, is still higher, and their own 5-year average, this one historically in the high single digit. Earnings per share, though, isn't looking too bad, projected 13% growth above the sector but below their historical 16%, and profitability coming bang on an A, 39% gross margin above the sector, in line with their historical. Bottom line, 19%, well above the sector at 6, not too dissimilar from their 5-year average at 20. Cash from operations, well, this one hasn't seen much growth, 1.47 billion versus the 5-year at 1.42. And institution, 78% ownership, selling 4 billion, bought a little bit more at 5 billion, and we can see not too dissimilar in Q3. So overall, no clear indication from institutions what they think about this company. In our intrinsic price at $155, worth flagging that on a DCF it does come lower at 140, where we've used a growth rate of 10% moving forward. Baked in is there or thereabouts at 9.6, so using all three in combination, an MOS of 12.5%. If you wanted 20, a buy at 124, and at 25, 117. Wall Street see 160 into next year, 18% upside, but let us know, Old Dominion Freight Line, buy, hold or avoid. We then move into Ferrari race, down 7% year to date. Over the last 6 months, down double digit 16. Over the last 10 years though, another outperform of the S&P, trading very near to 52-week lows. Buy from Seeking Alpha, Wall Street very respectable at 4.38 with another sell from Quant, and valuation at an F, 131% premium to the sector, trading at 38.95 but a 16% discount to their 5-year. Price to earnings growth does look quite costly at 4.1, 151% premium to the sector, 21% premium to their 5-year, and growth at a B- around 10% last year, 11.5% this year. We see the sector a lot lower, so they are growing faster. That is good to see, but over the last 5 years, they have grown a little bit more. In terms of EPS, projected 9 to 10% over the next 3 to 5 years, in line or thereabouts with the sector, but again, like revenue, historically a little bit faster. And profitability at an A, gross margin 51%, well above the sector at 39, not too dissimilar from their 5-year. Net income though 23% above the sector at 4%. We do notice nice efficiency to their 5-year average, with cash from operations 2.8 billion above historical 1.7, and institutions sold 4 billion in the last year, bought a lot more, nearly 4 times as much, around 16 billion, but actually in Q3 they have started selling more. Q2 was where we did get a huge buy at around 10 billion, and our intrinsic value just under $400 is derived using the lower growth rate of 15%. You'll see baked in is there or thereabouts. If you believe it can hit the higher end, well, we're talking about a double. But using that lower rate, the margin of safety today is only sitting at 1%, saying essentially we believe Ferrari is trading around this fair price. Wall Street disagree. They see $500 into next year, 28% upside, and if you agree with the 15%, well, 10% MOS, a buy at 356, at 20%, 317, and 25, 297. If you do want to see that middle rate, well, at 20% growth moving forwards for race, you will notice a 31% margin of safety. Let us know your views on Ferrari. We then move on to Deckers, which has been absolutely slapped down 61% year to date, 33% in the last 6 months. Over the last 10 years, though, huge outperformance, up 915%. All-time highs, we can see beginning of the year around $220, trading at 52-week lows. Double very weak buy ratings from both Seeking Alpha and Wall Street. Where the valuation at a C-, you're getting a 24% discount to the sector, 48% discount to their 5-year. Price to earnings growth, bang on at 3, is an 82% premium to the sector. Where we notice their growth does get a deep, but look, year-on-year revenue up 13%, forward-looking around 10%, above the sector, but like most companies that have started to crash, they are growing slower than their own 5-year. Earnings per share lets them down massively, only 4% projection when the sector sits above at 10 and their 5-year at 15. And profitability, like most companies today, at an A, gross margin 58%, above the sector at 39, huge improvement to their 5-year at 54. Bottom line 19%, again the same conclusion, well above the sector, and nice efficiencies to their 5-year. They've also now generated over $1 billion in the last year, much higher than historical $658 million, where we notice very high institutional ownership at 98%, $3.5 billion selling, a lot more buying in the last year. We noticed nearly 4 times as much, but pretty much double the amount of sales in Q3, something that has changed the narrative in just the last few quarters, where they were buying more than in fact selling. And our intrinsic price, $127, is derived using a growth rate on the lower end of 2%. In fact, in the most recent year, it sat at 3%, and baked in today around $79, 52-week lows, is a decline of 5% every single year. If you want to use 6%, which a lot of people would argue isn't even that unrealistic, well, more than a double at 111%. But using the low rate of 2%, you are getting a margin of safety of 38%. Using the middle rate, in fact, of 4%, again, not unreasonable, 46% MOS. Regardless, Wall Street see a lot of upside, 43% into next year, $113. So let us know about Deckers. And then we look at Chipotle Mexican Grill, battered 47% year to date. Over the last 6 months, 37%. Over the last 10 years, this one has now underperformed the S&P, trading, as we said, lots of companies today at 52-week lows, with Seeking Alpha, weak buy, Wall Street, very respectable, 4.3 out of 5, and the valuation at a D-, 63% premium to the sector at a forward P of 27, 51% discount to their 5-year, and price to earnings growth now sits around 2, but do note that's still a 21% premium to the sector, but now a discount of 18 to their 5-year average. And the growth at a C+, we can see grew last year 7%, expected 10% this year, above the sector on both accounts, but lower than their double digit on the last 5-year average. EPS projected around 14%, yes, above the sector at 10, but huge drawdown from their historical 24% average. And with an A on profitability, 40% gross margin, slightly above the sector as well as their 5-year average. Bottom line, 13%, looking good when the sector sits at 4%, and their own 5-year a little bit lower than their trailing 12 month. And institutions with their 91% ownership selling $8 billion in the last year, bought a lot more at $13 billion, whilst in fact doing the opposite in Q3, selling more, in fact a lot more than they did buy. And our intrinsic price at $37 does in fact come from a 12% growth rate, baked in today given that drop that we saw after their earnings. 9.3%. So using the middle rate of 12%, you are getting a margin of safety of around 14%. Wall Street still very bullish, $48 into next year. That is 50% upside. And if you want to see the lower end today at 8%, well, you can in fact see a premium of 13% for Chipotle Mexican Grill. Will depend ultimately on where you see the growth over the longer term. But as always, let us know your views on CMG as well as the others today. And don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.